In this video, we want to explore what's referred to as the stock value dividend valuation model. So we're going to look at a model that looks at the dividends that a company pays and to try to evaluate what the current value to the investor might be. And again, if whether or not that stock would be a good investment for that investor. So what kind of information do we need to know? Well, our basic formula is here. It's next year's dividend divided by R sub S, which is the required return on the stock, minus the growth of the stock. So let's kind of start with some data that we might need for this evaluation. So let's talk about dividends first. We looked up the dividends for this company, and 5 years ago they had a dividend of $1.15. The most recent dividend was $1.50. So this tells us historically dividends have been growing at roughly a 5.46% rate of return. Now there is another way to calculate this growth rate, and that is by looking at what they refer to as the retention rate. Right? So the company pays out dividends. Of the earnings that it pays, the company pays out 38%, which means they keep 62% of earnings to reinvest. The rate of return on equity tells us what rate of return they earn on investors' money. So on this 62%, they earn 15.6%. So another calculation of growth could be 9.67%. So how do we want to do this? Well, we can look at this and say, well, let's just use the average of the two. I mean, if they make sense, you use them. And in this case, it does, right? So somewhere up here, I have the growth rate. I plugged in 7%. It's somewhere between what? 5.5 and 9.5, I chose 7%. Again, as an investor, you get to plug in what you want, right? If you think that the company is going to be more successful in the future, I mean, as an investor, you can adjust the numbers. You can say, the average is 7, but I bet you it's going to be closer to 8%. So you can change that number because you're the one that's doing the analysis. What this also does then is gives us the most recent dividend, D sub 0, so that we can calculate D sub 1. So again, we have the average of 7%, and D1 then is D0 times 1 plus the growth rate. Now we also need to talk about this required return. What number could we use? Well, there's two ways we could do this calculation. First thing we could use is the security market line from our capital asset pricing model theory. The risk-free rate's 3%, the average rate of return in the stock market's 10, and this company has a beta of 1.56. So the required return, according to the capital asset pricing model, is 13.9%. Now we also can look at another way of looking at returns, and that revolves looking at the dividend yield plus capital gains. So how do we find the capital gains, this 7%? Well, that's what we refer to as this growth rate. The growth rate in our formula is assumed to be capital gains. Dividend yield then, in this case, we just take the future dividend and divide it by the price. That's dividend yield. So given this company what we think is going to happen to dividends, we think it'll have a rate of return from dividends of 8%. Add those two together, gives us 15. So again, what number do we want to use? It's somewhere between roughly 14 and 15. So I chose 14.5%. So again, One of the things we have to worry about with this model is, will it give us a logical answer, if you will? So if G is greater than R sub S, then this model won't work. You'll have to find another model to work, or reevaluate your growth rate of dividends and see if they make sense being greater than the required return on the assets themselves. So again, in this case, what we find out is the value of this stock is $21.40. The current price of the stock is 20 bucks. Would you pay $20 to get something worth $21.40? Of course you would. You're getting a greater value than what you're paying. If you actually bought it for $20, we estimate that you would get an expected return of about 15.03%, and your required return was 14.5%. So again, both ways of looking at investments, yes or no, is they give the same answer, right? It's just one's in terms of dollars, one's in terms of percentage. Again, hope you liked that video. Look forward to seeing you soon.